So just had a client ask me about mortgage insurance. A couple things to know. If you have a mortgage on your home and you escrow your homeowner's insurance, escrow means include it as part of your payment. You'll have your mortgage statement and it'll say this is what you're paying for principal and interest. That's to repay the debt you borrowed. Then you have a section for homeowner's insurance, and that is basically 1/12 because there's 12 months in a year. So 1/12 of your annual premium. So if you make 12 of those payments, your mortgage servicer should have enough money to pay the annual premium by the time the insurance company asks for their new premium. So you pay your mortgage company monthly, and they're just going to hold that money, and then once a year they're going to pay a bill for an annual bill for your insurance provider. Same would apply for your property taxes. Just understand that's just escrow. Now what I want to go into now is mortgage insurance, which is completely different from that. So mortgage insurance is something that you would be required to carry if you're buying a home and you either A, get an FHA loan, or B, you're getting a conventional loan and you don't have 20% equity. Those are the two circumstances that you're going to need to carry mortgage insurance. What mortgage insurance does for you is honestly nothing other than it allows them to give you the loan. So if there was ever a claim or an issue, they're not cutting you a check. That check goes to the lender to protect their investment. So the gist of it comes down to this. If you have mortgage insurance on your loan, it doesn't mean you were wrong, bad. It's just that's what was necessary for you to get the home that you wanted with the down payment that you were willing to do. After that, though, the good news is there are ways to remove mortgage insurance depending on what loan program you have. FHA loans, typically, that mortgage insurance is going to be permanent. Now, there's a couple exceptions. If you bought a home and put down 10%, there's a couple of things like that, but we're not going to get into that to keep this video light and easy. But most people do not put those larger down payments down on an FHA loan. If you have an FHA loan, you're going to need to do a refinance to remove that. And that's what people typically do, because usually they buy this home and they put down a low down payment. They get into the house. Over time, they pay the mortgage down. That balance goes up. Now they have equity. That's whenever they would subsequently do a refinance. If you have a conventional loan, in those cases, there are two ways to remove mortgage insurance. First way is if you simply pay down your loan, you keep making payments, at some juncture, your loan balance will be 78% of the original value of the home, not today's value. Whatever the value was when you bought it, that value, that appraised value, that's what you're going to get. So when you get down to 78% of that number, it comes off. That, depending on what your down payment was, it's going to take a long time. That's not just going to come here quickly, typically. The way that most people accelerate removing mortgage insurance off their payment and saving them money, basically contact their mortgage servicer and you can order a valuation on the home. It's basically, obviously an appraisal. And if that valuation shows that your loan balance is now only 80% of the value, they will drop it off. So for example, if my home's worth 100 grand and my mortgage balance is now only 80, I call and get that valuation, I'm out, provided that I've been making my payments on time. If I'm late on my payments and stuff, they're not gonna entertain all that. The gist of it is there's two ways to do it. The most efficient way to do it is to order that valuation. If you guys have any concerns or you want us to just do a quick lookup, we can kind of give you an idea.